Hello friends, welcome back to the channel, and I have some genuinely good news today because there are three separate pay raises that are either on the way or already available for UK pensioners, and the vast majority of people do not know about all three. The first is coming in April. The second is one you can give yourself for less than £1,000, and the third is already sitting in the system right now, worth up to £5,959 a year, and roughly 1 million pensioners who are eligible for it have never applied. I have gone through the latest earnings data, the DWP benefit rates for 2026 to 2027, the National Insurance Contribution rules, and the official eligibility criteria, and I am going to walk you through all three today, because when you understand how they work, and more importantly how they stack together, the difference to your annual income could be thousands of pounds. Now, before I get into it, I want to say something to those of you who are already subscribed. Thank you. You understand that pay raises for pensioners do not arrive with a letter of congratulation. They are buried in benefit uprating tables, NI contribution rules, and eligibility criteria that nobody explains in plain language. The pensioners who subscribe to this channel hear about these things in time to act. The ones who are not subscribed hear about them years later, if at all, and by then the money they could have claimed has gone. If you are watching right now and you are not yet subscribed, one tap changes that. No cost. And it means the next time a raise is available, you will be the first to know, not the last. Now, there are three raises on this list, and I want you to stay until the very end, because raise number 3 is the biggest single increase most pensioners have never heard of. It is tax-free, it does not depend on your income or your savings, and claiming it can unlock a cascade of other benefits that could be worth thousands more on top. Let us get into it. The first raise is the one that will appear automatically in your state pension next April, and the early figures suggest it could be one of the largest increases in recent years. Under the triple lock guarantee, your state pension rises each April by whichever is highest of three measures. Average earnings growth for the 3 months from May to July, consumer price inflation measured in the year to September, or a floor of 2.5%. The government is committed to the triple lock for the duration of this parliament. It is not under review. It is not being quietly dropped. It applies next April and every April after it until the next election. The current full new state pension is £241.30 per week, which is £12,548 per year. As of early August 2026, preliminary earnings growth data is tracking at approximately 4.2%. Inflation is running below that, which means earnings growth is likely to be the highest of the three measures, and your state pension could rise by roughly 4 to 4.5% from April 2027. In cash terms, that is an increase of approximately £500 per year. Your weekly state pension could rise from £241.30 to roughly £251 per week. That is a meaningful raise by any measure. But here is the part most people have not thought about, and it is critical. The personal allowance, the amount of income you can receive before you start paying income tax, is currently frozen at £12,570. It has been frozen since 2021, and it will remain frozen until at least April 2028. Your current full state pension is £12,548. That is just £22 below the personal allowance. A 4% increase takes it above that threshold for the first time. That means from April 2027, if you receive the full new state pension and any other income at all, even a small workplace pension, even modest savings interest, you will almost certainly owe income tax. And if you receive the full state pension and nothing else, the pension itself will be taxable because it will exceed the personal allowance on its own. This is not a reason to worry. It is a reason to prepare. If you are not already registered for self-assessment and your only income is your state pension, AMRC will typically adjust your tax code if you have another source of income that is taxed through pay, such as a workplace pension. If you do not, you may need to complete a self-assessment tax return. The action is simple. Check your tax code now using your personal tax account on gov.uk or ring HMRC on 0300 200 3300 and make sure your records are correct before next April. The raise is coming. Make sure you keep as much of it as possible. The second raise is one that most pensioners do not think of as a raise at all, but it is. It is the most cost-effective way to permanently increase your state pension income for the rest of your life, and it costs less than £1,000. If your state pension forecast shows that you have fewer than 35 qualifying years of national insurance contributions, every missing year is reducing your pension. You are not receiving the full rate, you are receiving a fraction of it. The full new state pension requires 35 qualifying years. Below 10 qualifying years, you receive nothing at all. Every year between 10 and 35 is worth 1/35 of the full rate. That is approximately £6.89 per week, or £358 per year for each qualifying year. If you have gaps in your record, years where you are not working, not paying contributions, not registered for national insurance credits, you can fill those gaps by paying voluntary Class 3 national insurance contributions. The current cost to fill 1 year is approximately £957. That £957 adds roughly £358 per year to your state pension for every year you receive it. The break-even point is under 3 years. After that, every year of pension you collect is pure return on that investment. Over a 20-year retirement, one filled year is worth over £7,000, but there is a deadline. Under the standard rules, you can only fill gaps from the last 6 tax years. The oldest gap you can currently fill is the 2020 to 2021 tax year, and you must fill it before the 5th of April 2027. After that date, it is permanently closed. The next year closes the April after that. Every year you wait, the oldest fillable gap disappears. The action is clear. Go to gov.uk and check your state pension forecast. It will show you how many qualifying years you have and whether you have any gaps. If you have gaps that would increase your pension, and not all of them will, so check first. Call the Future Pension Centre on 0800 731 0175 and confirm that filling a specific gap will actually increase your forecast. Then pay it. One payment. Under £1,000. And your pension rises permanently. Now here is the third raise, the one I told you to stay for, the one that is already available right now, and it is the largest of the three by a significant margin. It is called attendance allowance. If you have reached state pension age and you have a physical or mental health condition that means you need help with personal care, help getting dressed, help washing, help preparing meals, help taking medication, supervision to stay safe during the day or the night, you may be entitled to attendance allowance. It is paid at 2 rates. The lower rate is £76.70 per week, which is £3,988 per year. The higher rate is £114.60 per week, which is £5,959 per year. And here is what makes attendance allowance different from almost every other benefit in the system. It is not means tested. Your income does not matter. Your savings do not matter. You could have £100,000 in the bank and you would still qualify if your care needs meet the criteria. You do not need to be receiving care from anyone. You do not need to have a carer. You just need to reasonably need help, whether you are receiving it or not. It is tax-free. It is paid on top of your state pension. It does not reduce any other benefit you receive. And according to the most recent estimates, approximately 1 million pensioners who are eligible for attendance allowance have never applied. 1 million people, leaving up to £5,959 a year on the table because they assumed they would not qualify, because they thought their savings were too high, because they thought they were not disabled enough, because nobody told them it existed. And here is the part that turns this single benefit into something much larger. Attendance allowance is not counted as income when calculating pension credit. That means if you are a pensioner whose income is currently just above the pension credit threshold, being awarded attendance allowance does not push you further away from pension credit. In many cases, the additional care costs associated with your condition can actually bring you within scope for pension credit for the first time. And once pension credit is in payment, it unlocks council tax reduction, the warm home discount, the winter fuel payment, free NHS dental treatment, a free TV license at 75, and cold weather payments. A single attendance allowance claim can start a chain reaction that is worth thousands of pounds a year in combined support. The form is called AA1A. You can download it from gov.uk or request it by calling the Attendance Allowance helpline on 0800 731 0122. Complete it based on your worst days, not your best. Describe what you need help with in detail. Include the name and address of your GP and any consultants. Most claims are decided on the paperwork alone. A home visit is rare, and once awarded, payment is backdated to the date the DWP received your form. One form, tax-free, non-means tested, up to £5,959 per year, and for many, the key that unlocks everything else. So let me bring this together. 1. The state pension is projected to rise by approximately 4 to 4.5% in April 2027 under the triple lock, worth roughly £500 a year. But the rise will push the full state pension above the personal allowance for the first time, so check your tax code now. 2. If your national insurance record has gaps, you can fill them for approximately £957 per year, adding roughly £358 per year to your pension for life. But the oldest fillable gaps close annually, and the 2020 to 2021 year must be filled by April 2027. And 3. Attendance allowance pays up to £114.60 per week, is tax-free, non-means tested, and around 1 million eligible pensioners are not claiming it, and it can trigger eligibility for pension credit and a cascade of linked benefits worth thousands more. 3 raises, 3 actions. 1 is coming automatically in April. 1 costs under £1,000 and pays for itself in 3 years. And 1 is already waiting for you right now, and all it takes is 1 form. If this video helped you today, I am going to ask you to do 2 things. Subscribe to this channel so the next time a raise like this is available, you hear about it first. And share this video with a pensioner you know, a parent, a partner, a neighbor who has arthritis, a friend with a heart condition, someone with diabetes who struggles to manage it on their own. You do not need to explain the whole video, just send them the link. Because 1 share, 1 form, 1 conversation about something they did not know they were entitled to, that could make a real difference. Thank you for watching, friends. I will see you in the next one.